Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Cash Flow Statement Analysis, a practical guide for better financial decisions. Why are these metrics important? They go beyond the raw data to tell you how efficiently your business handles cash. A healthy cash flow margin shows profitability, while a solid operating cash flow ratio signals stability. When both are strong, it's a sign your operations are running smoothly, and the business is well prepared for challenges. Regularly tracking these metrics can help you spot trends early. Are margins shrinking? That could mean rising costs or inefficiencies. Is the ratio dropping? It's time to review debts and tighten cash management. Think of these metrics as the dashboard lights in your car. They alert you before bigger problems arise. Understanding these details allows you to make informed decisions that keep your business not just surviving, but thriving. Investing activities analysis. Investing activities on the cash flow statement reveal how a business allocates resources in long-term assets or investments. This section reflects the cash impact of strategic decisions, like upgrading equipment, acquiring property, or selling assets. Understanding these activities can help you identify trends and assess whether a company is investing wisely for growth or liquidating its future potential. Capital expenditures impact. Explain how investments in assets affect cash flow. Capital expenditures, CapEx, represent significant purchases of physical or intangible assets, like machinery, real estate, or software. These investments often consume large amounts of cash, making their impact on the cash flow statement critical. CapEx usually falls under cash outflows because businesses spend now to build value or productivity over the long term. For example, a manufacturing company might buy advanced equipment to increase production capacity. While this is a positive move for future growth, it reduces cash reserves in the short term. The more a company invests in assets, the more immediate pressure it places on cash flow. But here's the key: not all CapEx is bad. When managed wisely, it signals long-term growth initiatives. On the other hand, excessive or poorly timed CapEx can drain cash reserves, forcing companies to rely on loans or sell assets to stay afloat. When analyzing CapEx in a cash flow statement, ask yourself, is the spending aligned with business growth objectives? Does the company generate enough cash flow from operations to cover these investments? Are they overusing debt to fund large purchases? Tracking the CapEx to operating cash flow ratio is one way to gauge whether investments are sustainable. If this ratio gets too high, the business may be stretching itself thin financially. Ideally, CapEx should support long-term growth without jeopardizing short-term stability. Investment cash flow trends. Discuss trends in cash flow from investing activities and what they indicate. The pattern of cash flows from investing activities can paint a clear picture of a company's financial strategy. Here are 3 common trends and what they might reveal. Consistent outflows. Regular negative cash flows from investing activities often indicate ongoing investments in assets. This is common for growing businesses expanding operations, launching new products, or enhancing infrastructure. While negative cash flow may seem troubling at first glance, it's often a positive sign if funded sustainably. A steady outflow suggests the business is reinvesting profits into areas that drive future growth. Large one-time spikes. A sudden jump in outflows could mean the business made a major purchase, like acquiring another company or upgrading facilities. These one-time events can significantly reduce cash reserves, but they also indicate bold, strategic decisions. Similarly, large inflows might signal the sale of assets or divestments. While this provides a short-term cash boost, frequent asset sales could hint at underlying struggles, like liquidity issues or declining profitability. Minimal activity. When the cash flow from investing remains relatively flat, it indicates little to no investment in long-term growth. While this could mean the company is conserving cash, it might also suggest stagnation or lack of opportunities to reinvest. In industries dependent on innovation, such inactivity may put the business at risk of falling behind competitors. A useful ratio to monitor here is investing cash flow as a percentage of total cash flow. Companies with high percentages in this category are likely focused on long-term growth, while those with low percentages might be more conservative or financially constrained. Looking at this data over time, rather than in isolation, helps you spot movement in strategy or potential financial red flags. By examining cash flow trends, you can uncover whether a company is prioritizing growth through investment or grappling with cash shortages. Are the investments paying off, or is the business treading water? The answers often lie in the patterns. Evaluating cash flow from financing activities. Understanding cash flow from financing activities helps you see how a company funds its operations and returns money to stakeholders. This section of the cash flow statement shows the cash impact of borrowing, repaying debt, issuing equity, and managing shareholder returns. It often answers critical questions like, how does the business raise capital? And, is it paying down obligations effectively? Here's what you need to know. Debt and equity financing. The cash flow statement highlights two primary ways businesses secure funding: debt financing and equity financing. Both bring cash into the business, but they impact future obligations differently. Debt financing. Borrowing money results in cash inflows when loans are taken out or bonds are issued. However, this comes with a trade-off: those funds must eventually be repaid. Payments on principal or interest create predictable outflows, which reduce future cash reserves. Companies might use debt financing for growth, covering shortfalls or stabilizing cash flows during rough patches. As a business owner or analyst, watch for warning signs like rising debt repayment obligations without corresponding growth in operating cash flow. Reliance on frequent borrowing, which could signal underlying liquidity issues. Equity financing. Issuing shares brings in cash without the obligation to repay like with debt. For investors, though, this dilutes ownership. The cash inflow from equity financing can support expansion, product development, or acquisitions. While issuing shares looks cleaner than debt, overuse might indicate the company can't generate enough cash organically or secure low-cost loans. When analyzing these activities, ask questions like, is debt being used wisely to invest in growth or simply to stay afloat? Are equity sales a sign of opportunity or desperation? A healthy mix of debt and equity financing often reflects a balanced approach to funding. Dividends and share repurchase effects. Financing activities also cover dividends and share repurchases, both of which distribute cash to shareholders. These outflows can affect cash flow and send key signals about a company's financial health. Dividends. Dividends reduce cash, but they reward shareholders and show confidence in future performance. When companies consistently distribute dividends, it can indicate stability. But during downturns, maintaining payouts might strain cash reserves. For cash flow analysis, consider, are dividends sustainable based on cash generated from operations? Has the company reduced or halted dividends to conserve cash? Share repurchases. When companies buy back their shares, they reduce the number of outstanding shares and return cash to shareholders. This can increase earnings per share and signal management's belief that the stock is undervalued. However, repurchases also represent a cash outflow. Excessive repurchases, especially in periods of low cash flow, may hint at poor financial planning. While dividends and buybacks can boost shareholder returns, excessive payouts could leave the business short on cash. It's essential to balance the benefits of rewarding investors with the need to fund growth and maintain liquidity. When you analyze financing activities, look at the big picture. Are inflows from loans or equity fueling growth or plugging gaps? Are outflows for dividends and buybacks sustainable? Together, these answers provide insight into how a business manages its cash and builds value. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.